So, today's video is covering the concept of gaps and gap trading. Now, first of all, for all of the new people who are entering markets, you should probably know what a gap is. A gap is essentially a time period on the chart where the market is closed, and then when the market opens again, the price is higher than where it was on the previous close, leaving this space on the chart. Now I'm looking at gold futures and you can see there's a giant space right here. It's just empty. See how empty it is? So the market closed here. Everyone settled down. Everyone went to sleep. Everyone logged out. And then by the time the market opened for the next session, it was here. And what happened is it created what people call a gap, meaning there's no price history here. It's just an empty space. It's a gap. You can literally color it in as you need it because there's nothing there. Now, gaps happen in markets at different times, and they don't always necessarily have to happen when the market's closed. I mean, think about something like Bitcoin. Bitcoin trades 24/7. So it's virtually impossible to find a gap on the Bitcoin chart on a daily chart because it trades 24/7. Every price is eventually just going to be, shown. There's not going to be this divergence between a close and an open, but you can still possibly get a gap on a 1-minute chart. For example, I see a gap right here. Check it out. On the 1-minute chart, there's a gap. Now, how does that happen when the market's open? Well, it means that when the price traded right here at the top of this candle, something suddenly happened within this minute where the bid and the ask jumped, and they jumped a space to not allow for essentially a bid or an ask to get filled in this level. Something bullish happened. And actually what's pretty interesting, even just by looking at this gap, is you can just see that once it gapped up, it actually went even higher from there. And that's kind of the point of this video that I'm creating about gaps, which is that they have this interesting place in trading activity, trading psychology, markets in general, where they represent something really interesting, which is, in this example, what possibly happened that made this gap just suddenly appear on this 1-minute chart? That means the bid skipped a level. It wasn't sort of going at this nice little evenly orderly uprise. Something happened and had to skip a level, had to adjust quickly. Looks like it went from 95,533 suddenly to 95,567 in a flash. But if you think about it, if that happens, that's kind of bullish, right? Or bearish if it's the other way. Something just changed the supply and demand so quickly that the gap appeared. And I don't have the exact backtesting statistics, but there's definitely traders out there, firms out there, who look into these gaps and try to figure out, what's the real bullish or bearish nature of them, and do they often continue upward in this way? In fact, from this gap all the way up to what we're seeing now, we've got this 0.25% move. This is a minute chart. So 0.25% in 20 minutes, 15 minutes. So that's the gap and why it's so interesting. And you'll even see it on the gold chart. Going back to gold, which is where we started this gaps introduction chat on a daily chart. You've got this gap here, and look at the move since the gap. 5% since the gap. If you go up to the highs, about 6% since the highs. So people really are interested in gaps from a trading perspective across all time frames and markets. And before I dive into some strategies or ideas on how to trade this, let me also just remind you that this happens in stocks, and this really happens in the stock market around earnings. Mostly, earnings tend to cause some of the biggest gaps you're ever going to see. So I've got this chart up of Apple, and I'm actually just going to delete all my drawings, and you can see here there's an earnings report. These icons tell you when there's an earnings report. You can see there was an earnings report here. We have this mega red candle here, and there's even this gap here. Briefly, the gap did get filled, and that's the point of this video actually about these types of trading strategies. And let's just go back in time for a second. So let me make sure I do this. Let's select bar. Let's go to here. Okay, let me delete my drawing because after all, this is an earnings report. So here's earnings and then the gap down. So huge gap up by huge bar essentially after earnings, it looks like. major news, and then a gap down the next day. Now, the way people will often trade gaps is essentially what I was just showing earlier, which is these runaway gaps. The gap happens and then it's off to the races. So gold on the daily chart, we were just looking at it. Where's that gap up that we saw in gold? I guess this was it. This gap up right here. Oh, that's right. I still have bar replay. So this runaway on gold, and then if you go to BTC USD on the minute chart, well, we went back in time, but you remember we had this gap up on the minute chart, and that sort of was the trade. It's a runaway gap. I'm going to come back to that, but let me go back to Apple, because another trading strategy that does exist is called gap fills. Now, recall we've got this gap here. So here's the close here, right? I'm trying to get my marker on it. And then here's the next day. And if you color in this area, there's an empty space. So this empty space between the 2 points. So a gap fill would be a trade that is essentially saying, I think this sell-off was overdone, and I think that the gap now will get filled at some point and, fill the area. And by filling, it means there's a candle and trading action within it. Now you have price history. The price history is filled in. Previously, we don't have any future price history here. We just have this gap, and now we're just trading to the future, not knowing who actually transacted here or who would transact here. And so when price finally enters this region, well, now you start to get price history. And so there are some sayings that gaps act as magnets. I personally really like that saying. It acts as a magnet. It attracts price. So actually, come on, how fascinating is that? First day, literally the gap filled. And you can judge it just by seeing the candle. And then even if you don't think it filled there, well, it surely filled here. But gaps act as magnets. So surely enough, price was attracted back to the gap. Great. But really now that the trade is done, and you just saw what happened there. The trade's done. It dropped the next day. Now it's testing the gap again. And now the gap is becoming sort of the short-term battleground. And it's so interesting as to why that might be happening. Well, let's really think about it. This gap was a place that had no price history. Some sort of large event like earnings played a role in the gap. And now price is being attracted back to it, and it's being hit multiple times and getting rejected time and time again. So what you have here now is the gap essentially becoming the battleground between the bulls and the bears. Imagine that you are sort of on a giant open field, and right in the middle of the field is a huge, long, just dug out trench, right? It's just dirt that's just dug out. There's nothing there. It's been all dug out. And then on one side, you have this army of bulls, and on the other side, you have this army of bears, and they're all just rushing toward the gap. And there's sort of this element of like, who's going to be able to jump into that trench, go up the other side, and still win? It's a pretty big deal to try to win that battle. But right now, the way you can think about it is they're both just standing on either side of the gap, trying to see who's going to take it. Were the bears right to sell this in the first place and to have such excessive selling, or is it a buy the dip moment where was it sort of too much too fast? And that's where I think the gap trading is really, really interesting. Going back to gold, you can think about it from the standpoint of a runaway gap. In this example, you can see it ran away, right? This is the runaway concept. But bear side or bull side, sometimes it's too euphoric. It's too much too fast. Wow, the momentum just took over. The buying just surged. The bulls are in control. But everyone knows both bears and bulls like to take profit. And so there's sort of this concept that people also look for or prepare for, where if they miss the move, they might wait for the gap to come back and get filled. So for me, even personally on this gold chart, we can come back and check this video in some time. I'm not doing anything at the moment. I'm not buying it, but I wouldn't mind a gold position. But if you're looking for that level, like where could it return to? Sometimes the gaps act as magnets to the downside, or they are sort of these retracement tools, which is, gold had an epic run higher. Wow, what a quick run higher for an asset of this size. And now maybe it sort of needs to cool down a little. And if it does need to cool down a little, maybe this gap is the target that you could potentially wait for. or sort of examine. And this, after all, is the important thing about gap and gap trading, which is you can use it as sort of a North Star up or down for future moves. And that's how I like to use it as well. It can be either a sign of a runaway gap like this, which is really bullish, momentum, or if it's the other way, let's just say this chart was going this way, it'd be gap down, very bearish momentum. And sometimes just in a true regression to the mean, a snapback to the forces, this gap was sort of the signal that made that kick into high gear, and now it's gone too far too fast. It's tilted the scales, there's an imbalance, it needs to come back. It just needs to come back and fill that gap. So that is the gap concept and how it can be traded. It can be used as a point for a runaway. The gap happened here, it ran away. It can be used as a point as a retracement. Well, I missed the move, so you know what? I'm just going to wait. And then lastly, it can be used just as sort of a sentiment read into why that happened. As mentioned in the Apple example, you might be wondering, like, how that gap happened. Well, we know it was earnings, so now we can dive into earnings. So it's a kind of a cue that something big happened. Now, one more really important thing about gaps as well is, do all gaps get filled? Do they all get filled? I like to think over a long enough time frame, every single gap gets filled because nothing goes up forever. So even on this NVIDIA chart, you can just see how many really crazy gaps happened that now are trying to get filled. So this gap would go up higher here to fill it here. You could see that there was a huge runaway here. So here's a big runaway gap back in May of 2024. But sure enough, look at it. It was filled. This area was eventually filled. So you'll find time and time again that the gaps do get filled. And even if you don't believe any of this concepts, you can still use it as a benchmark that things do oftentimes return to that level. NVIDIA, though, for example, what's rather interesting, if you really pay close attention here, let's see, it still hasn't actually filled this gap here from early 2024. So not all gaps do get filled. And if we go back in time, there's another one here as well from 2023. So not all gaps get filled. And you never know, NVIDIA might not come back down here for 10, 20 years. But now you at least have some levels to keep in mind. These were epic events that started the runaway. This was its first enormous earnings beat, or one of the first big ones, maybe with a really bullish forecast. Yep, that's right. So they changed their outlook. Or even here, back in the same time, actually, looks like February 2024, another gap. So the gaps are also these signs of where to look and what happened. And that's what sparked this move. And one more important thing about gaps that I am noticing about this NVIDIA chart actually is that if you do drag this up to the high here, you can see that sometimes you can use gaps as support lines, these inflection points. So NVIDIA made this epic move from the gap here. It goes up to almost 30%. It then did retrace, but look at where it retraced to. Surely enough, it retraced and it quite literally hit this level right here. Look at this, right there. Hit that level right there. So very, very interesting stuff here to see that it can also be sort of an inflection point or some sort of support or resistance that you could ultimately keep in mind. So that is my introduction to gaps. I've got a lot more videos coming into gaps. I hope that this free little walkthrough helped you and it helps you, look at gaps in the future. And just one more thing, because this is the most important thing. I probably should have explained this. What's something that's gone down a lot over time? Let's think here. Maybe Nokia's gone down quite a bit. Now, the reason why I want to talk about this is this next component is just really important, which is that people who abuse gaps the most, though, are those who are losing money, actually. So let's just say you happen to own a chart that's down quite a bit. From the highs here, Nvidia's down, or Nokia's down 95%. Yes, gaps act as magnets. Yes, they have these interesting historical reference points. It doesn't mean that just because there's a gap somewhere that it's just suddenly going to cause it just to spike higher. That's not true. It's not a good way to think about it. It's a reference point. It's probably better on the short-term time frame. And if I can get a Nokia daily chart long enough, it doesn't look like I can. I could probably change this maybe to a 5-day. Let's do this. Maybe let's do like a 3 days. I should still be able to see a gap or two. Let's see, 3 days. Okay, let's see if we got any gaps. Yep, we got a gap right here. Perfect. So if you look here, this Nokia gap takes us all the way back to 2008. Really interesting, right? Nokia all the way to 2008. It has not gotten back to this level though now for 15 plus years, basically. So if we, it's down 78% since then. Just because the gap is there doesn't mean it's going to get filled. But look, if you think you're a if you found something, you did your fundamental research, you've done your planning, you've looked into it, you have a small position, you think there's something on the horizon, that's an interesting level to strive for. Maybe there's a world in which you have uncovered something that actually is undervalued, and then there is this sort of play back to this gap level, and that becomes a point where, the fundamentals don't matter as much as the technicals, the gap, the psychology of the move, and maybe that's your exit. You found it down here, you exit up here, you use the technical capabilities of the gap to sort of plan your exit. That's one way to think about it. But the key ending note here is don't let gaps, just don't let them be hopium. Just because there's a gap doesn't mean it's going higher, especially over these longer term timeframes. You don't know what changed. Does the share count increased? Is the business in the dumps? It's really needs to be examined way deeper than that. So with that being said, this is my video about gaps, and I hope you enjoyed it.